Hi, this is Tim Enneking, and I'm Managing Director of Digital Capital Management. Today we're going to talk about a word that I coined that is near and dear to my heart called trichotomy, specifically the crypto trichotomy. So like a dichotomy relates to two different things, two alternatives, a trichotomy relates to three. The focus here, though, is on how the crypto space and even the word crypto has evolved over time. If we look at the phrase cryptocurrencies, which is not really one I like because crypto is very, very general and currency doesn't really apply to most trading tokens, which is the name I prefer. Really the origin or the original cryptocurrencies were exactly that, trading tokens. That is, they were cryptocurrencies, or we're going to call them tokens, that you could buy and sell on an exchange. Certainly that was true of Bitcoin, true of ETH, and true of the newer ones, or the ones that came after that that have several years under their belt, several years of existence. And that category is really unique. For a while it was the only category in the crypto space, and it was interesting because many different investment funds, including us, tried to come up with a taxonomy, a categorization of those various cryptocurrencies. So most of them included things like exchange tokens. They would include utility tokens. They would include security tokens. And there was this one very, very little category that most people didn't like because there was no pop in terms of the ICO, the initial investment, was asset-backed tokens. So it's a special category that was backed by, let's say, gold, or another good one would be diamonds, although I don't think the one attempt at that has actually succeeded. But the concept is we're going to have tokens that will be backed by gold, and in the case of gold, there would logically be a small premium that those tokens would trade at because gold is heavy, gold is difficult to move, gold, you can divide it up and you put it together, but it takes a lot of heat and infrastructure to do that, and you can do all of that much more quicker with tokens. So there'd be an initial raise, and maybe there's a 15% premium, let's say, and that 15% premium, just is preserved as gold goes up and down. Diamonds is the same thing, although you can arguably make a greater premium or make an argument for a greater premium, because while gold is very, very fungible, you can take it apart and put it back together, you can't do the same thing with diamonds, or rather you can in terms of taking them apart, but you really, really reduce the value, so there's no incentive to do that. So single diamond with very, very high value is difficult to fractionalize in terms of ownership. If you tokenize it, it's actually very easy. Those asset-backed tokens were the sixth or fifth or seventh category of tokens in the heyday of ICO in 2017. But actually they've now emerged, or the asset-backed tokens has emerged as an entirely separate category. I'll come back to that in a second. The other thing that's happened from the very initial days of Bitcoin, 10 years ago, or when I got involved, six and a half years ago now, is that everyone knew, okay, yes, the Bitcoin is recorded on this ledger, this decentralized ledger, but nobody really viewed the ledger as having any independent value. That ledger has now become the blockchain, and we have DLT, decentralized ledger technology, and what the realization has occurred to everyone that trading tokens in particular go one way, and the blockchain can be used entirely separate of them. The example I always use, or the phrase I use in this regard, is that trading tokens need the blockchain, but the blockchain don't need trading tokens. In other words, a token, which if you go to token rings and various other things, is simply a piece of data, and which travels around a computer network. Now, you have to have a blockchain for the trading tokens to record the various exchanges, and you need tokens if you have a blockchain, but they don't have to be trading tokens. And the example I use is usually with T0. Right now, the way transactions are settled in U.S. equity markets and most global equity markets is T2 or T3. So the trade plus 2 days of the trade plus 3 days is when settlement takes place. Settlement simply means you can get the cash back for your stock. Now, if you sell stock one day, or 1 minute, you could immediately buy new stock. But if you want to pull your money out, it's going to take 2 or 3 days because that trade has to settle. T0 is settlement in real time or near real time. Now, NASDAQ is working on a T0 project to settle trades in real time or near real time on its exchange. But there are no trading tokens. The T0 project, run under Medici, which used to be under Overstock, or I guess it still is under Overstock, but Overstock has spun off its non-blockchain projects. It is really the same concept as blockchain, but it's saying, okay, look, there's a market for these tokens, so it's selling the tokens. In that particular case, by the way, T0 had tremendous difficulty selling all of those tokens and ended up selling about half of them to a Japanese investment firm. So you have the blockchain concept, and the biggest blockchain project is right now is probably IBM and Maersk working on logistics, because logistics is just a blockchain, putting logistics on a blockchain is just a fabulous project. So you have trading tokens now, you have the blockchain, which doesn't necessarily need trading tokens, and the tokens may not really have any particular attention paid to them, and then you have asset-backed securities or asset-backed tokens. And that's the trichotomy, these three areas. And the interesting thing is that the later ones will probably be the most valuable. If you look at trading tokens, we're certainly looking at $1 trillion in net worth, with the entire market cap hit about $800 billion in the peak almost 2 years ago now. So we're looking at a probable aggregate multiple market cap in single-digit trillions for the origin, for the cryptocurrencies or trading tokens. The second spin-off of that is the blockchain. And if you look at the value of the businesses that are going to be built on the blockchain and the value of the assets that will be traded on the blockchain, we're talking double-digit trillions of dollars. Then, when you get to the third category, so the tokenization of real assets. So notice it's no longer asset-backed cryptocurrencies. So because there was the cryptocurrency that was leading and the asset aspect behind it. Now we have tokenization of real assets. So the real assets are driving the trade, and the tokenization is simply another way of securitization, or as I like to call it, it's the atomization of ownership. And the word crypto doesn't appear in the third category. It doesn't actually have to appear in the second category discussing the blockchain either. That category, asset-backed tokens, will probably hit triple-digit trillions of dollars with just real estate alone. But if you think about tokenizing artwork, wine collections, collectibles, real estate, virtually anything that would have any sort of mass interest, the maximum value of all of those assets is absolutely enormous. And triple-digit trillions is not that insane a number, not insane at all when you consider that the total value of derivative contracts in the world today is somewhere around $450 trillion. It's a real rough estimate because nobody really knows, but it's an enormous amount. And if you think about tokenizing bonds, for instance, which would be very interesting because right now bond ownership is really in the province only of the very wealthy individuals or institutions, you're talking tens, if not hundreds of trillions of dollars just in that single market, and that excludes real estate. So that is the crypto trichotomy, where we began with cryptocurrencies, which I now have rebaptized trading tokens, a blockchain excluding trading tokens, which really just logistics alone is going to make that at least an order of magnitude more valuable than trading tokens, and then the tokenization of real assets, which will almost certainly be another order of magnitude more valuable than the use of the blockchain. So again, my name is Tim Enneking, the Managing Director of Digital Capital Management, and I appreciate your listening. Thank you.